First of all, my name is Andrew Ackerman. I run DreamIt's accelerator program in New York. What exactly that means is the topic of this presentation. So just before I start, let me just know, who here is working on a startup? Okay, you guys are kind of in the right place. Who else is not working on a startup? Okay, I'm really curious about you guys, but we'll talk about that later. So the topic here today is what exactly is an accelerator program? Do you need one? And if you do, how do you choose the right one for you? So number one, don't take notes, right? Everything I'm about to give you is available online. I posted it to my blog about a half hour ago. My blog's As Angels See It. Or you could go to SlideBean, that's like Coffee Bean, but SlideBean. It's the presentation software I use, and you can just search for CrushIt, it'll be there. So this, in a nutshell, is what an accelerator does. We take your startup, and we hurl it further and faster than you ever thought possible, over barriers or through barriers if necessary. The feedback I get from my program is that in our 3 months in our program, our startups achieve a year to a year and a half worth of what they could have achieved on their own in the wild. So let's also define terms a little bit, because people use terms like accelerators and incubators and labs, and it means whatever they want it to mean. So here's what I mean when I say a startup accelerator. Number one, it's very exclusive, very selective program. You have to apply to it, and not everyone gets in. Number two, an accelerator invests its own capital, right? We put our own money on the line. Number three, we put a lot of hard work into it, a lot of sweat equity. We spend a lot of time with you making the company a success. Number four, we receive equity in the startups. How exactly that deal works varies from accelerator to accelerator, but that's pretty standard from what I mean by an accelerator. And number five, there's a fixed time period. In our case, it's 3 or 4 months. And lastly, it's largely or entirely co-located. And by that I mean you come into the program, into a room with the other startups in the program. There's a whole sense of community built around it for at least some part, if not all, of the program itself. Now, what actually goes into an accelerator program? And it varies from program to program, but most of them have these elements. Regular partner meetings or mentor meetings. By which I mean the senior people in the accelerator program sit down with you at least weekly, if not more, to see what's going on with your company, what progress you've made, how they can help you for the upcoming week. And at the same time, you're also hooked up with mentors on a regular basis, ideally a mentor that's specifically chosen for your company. And they also will help you on the details of how you make a company in your industry succeed in the market. Number two, there's speakers and other educational elements. I don't call them classes on purpose. This is not school, but you do learn things, and it's usually, if done right, kind of just-in-time learning. As you get to the point where it's time for you to start thinking about customer acquisition, bang, we should be bringing in a speaker that's talking about growth hacks. Third thing that good accelerator programs have are introductions, not only to investors, though they are crucial, also to customers, channel partners, experts, anyone that can help you move your business forward. A large part of the value we bring to the table is we bring those people to you right away. And these are introductions that in the real world you could spend months trying to get to the right person and maybe not even get to them. And we bring them in with a phone call or an email. One of the other pieces, and this is probably one of the lesser pieces, but it's especially useful for coming to a new country and you're starting from scratch, is the infrastructure support, the office space, legal support, bookkeeping support, all the other stuff that has to get done but you really don't want to think about when you're building a business. There are also social events. It sounds a little touchy-feely, but it's actually pretty important. You're going to be in this program for 3 weeks, and while that's a really short period of time, it's also a long period of time to have no fun at all. And lastly, Demo Day. Demo Day is your opportunity to pitch your startup in front of investors. And that is a pretty big deal. In fact, the whole goal of this program, of any accelerator program, if it's truly an accelerator, is to help you achieve your next milestone, which in most cases is getting you to a point where you can raise your next round of funding. Now, I want to be clear about what I'm not talking about. I'm not talking about co-working spaces. These are usually open admission, meaning you show up with a check, they'll give you a desk, right? They don't put any money into your business. They get rent from you. That's usually how the deal works. It's a real estate transaction. And there's no time pressure. You stay as long as you like, as long as you can pay for your desk. Now, there may be some value-add services there. They may bring in speakers. They may have other kinds of support. So they do have some elements in an accelerator program. But at heart, this is a place where you can sit and work. It's not a place that's aimed at pushing you forward to the next stage. And I'm also not talking about what I call incubator programs. These tend to be kind of more open admissions or less selective. They may be affiliated with the university, or they may simply be places where you pay for certain content and services. In general, they don't put their money into your company. And generally speaking, you don't give them equity. You either get in for free if it's an economic development group, so you're affiliated with a city or a government, or with a university, or you pay a certain amount of money and it's structured maybe a little bit more like an academic program. Now, there may be some hands-on assistance. They're usually not the same type of mentors, but they will try. And in many cases, these are longer-term programs. They can be 6 months or a year, and it could even be a stay as long as you want until you get that. It's a very different type of program. Now, here's the way you can tell if you're in an accelerator program versus one of these other programs. If you're in a good accelerator program, it feels like this. You're getting a lot done. It's coming at you fast, it's coming at you furious, and that's a good way to feel, because that means you're pushing yourself. That means you're taking yourself to the next level. So let's pause for a moment. Let's try to decide if you need an accelerator program. So here's the acid test. At your last startup, were you a C-level? Were you, a high-level guy at your last startup? Did it succeed? Did you make a lot of money for your investors? Do you know a lot of angel investors or venture capitalists? Are you familiar with the geography that you're going into? So if you are, and if you have a good network and you can support all of that, you probably don't need an accelerator. You're probably able to go at it alone. If any of these things don't apply, you may want to consider an accelerator because they're extremely good at filling the skills or network gaps that are up on that screen right now. And if you're still not sure, here's the stat to consider. On AngelList, this was as a couple weeks ago, there are over 500,000 companies listed. That's 500,000 companies, and those are only the startups that are listed on AngelList. Show of hands here, who's listed their startup on AngelList? Okay, that's not a lot of hands. Who has a startup that's not listed on AngelList? Okay, so you see that number's actually low. That number's actually low. So that's how many startups there are out there, all trying to ultimately build great businesses, get funded, and then, well, make a lot of money. So there's an analogy I use to help me think about the accelerator world and whether it makes sense and how to choose the right accelerator. And the analogy is the MBA program. There are a lot of students going into MBA programs, and there are a number of MBA programs out there. So you could ask yourself the same question. How do I choose what business school to go to? Well, here's an interesting fact. For the past 15 years, 8 of these 8 schools have consistently been in the top 10. And there's no surprise there. It's Columbia, it's Chicago Booth, it's Harvard, it's Kellogg, it's MIT Sloan, Stanford, Wharton, Berkeley, that's the one I missed. And the 9th and 10th one rotates between another 4 or 5 slots. It's the same year after year. And the reason for it is there's a virtuous cycle going on here. And what I mean by a virtuous cycle is that there are things that feed each other that make it better and better to be at the top and harder to break into it. So what happens here? You have the best candidates applying to the best business school programs because the best companies recruit at the best business school programs. But then the best companies recruit at the best business schools because that's where they find the best candidates. So it's circular and it reinforces itself. And on top of that, the alumni who all went to the best companies that we want to work at, they recruit at the schools they came from. So if you think about it, it's not surprising that once you get into the top 10 or the top 5 programs, it is really hard for someone else to dislodge you. Now we have the same virtuous cycle. It's beginning to play itself out in the accelerator world. It's still a little bit early in the game there, but the same factors apply. So you have the best startups. They want to apply to the best accelerator programs. Why? Because that's where the angels and the VCs are actively prospecting for potential investments. And why are they prospecting at the best accelerator programs? Because that's where they find the best potential investments. That's where there's the least noise, the highest hit ratio. And then you've got the alumni of the accelerator programs who, when they see a great startup, they of course refer them back to their program. So the same virtuous cycle, and it's becoming harder and harder if you want to start a new accelerator program, especially in established geography, for you to get into that top 10 for the same reasons we talked about with the MBA program. Now here's an eye-popping stat that I came across just the other day. 76% of all venture capital funding of seed accelerators programs go to the graduates of just 5 accelerators. And no surprise, you probably could guess the 5. Y Combinator, Techstars, 500 Startups, AngelPad, and of course DreamIt. Now let's think about that for a moment. Of all the companies that went through accelerator programs and ultimately raised money, 76% of those people that raised money, 76% of that money went to graduates of these 5 programs. So that leads into the next topic. So how do you choose what accelerator is right for you? Well, number one, you might as well start with the lists. There are a number of lists coming out that attempt to rank the accelerator programs. None of them are perfect, just like no list of MBA programs are perfect. And people all have different methodologies of how they choose the companies, but I would say if you find 3 or 4 lists, like the Forbes list or the MIT list, that's a good place to start. If you're seeing an accelerator program that's not on any of those lists, think twice about whether or not it's even something you might want to consider at this stage. Then dig deep into the subtleties of each ranking program, because it's a complicated program. Now, truthfully, at the end of the day, there's only one thing that determines the success of accelerator program. Does anyone want to guess what that is? Now, raise a hand if you think you got it. What determines the success of an accelerator program?
Future customers and funding.
Future customers and funding. No. Sorry about that, but that's no. What's the one thing that determines the success of an accelerator program? Are you raising your hand or scratching? Oh, so he's like, no, not me, not me. Okay, I won't force you to. The number one thing that determines the success of an accelerator program is how much money you made your investors. We're all backed by investors, whether it's formally a VC fund in our case, or whether it's the accelerator itself. The only thing that matters at the end of the day is, did we make a lot of money? Otherwise, we did not succeed in our mission. Because we're an accelerator, we're a profit-making venture. The problem is that that's a 9 or a 10-year journey, and we're still very early in it. So until then, we have to come up with other metrics along the way to help us determine if we're on the right track. And that's, by the way, where funding comes in, right? The amount of companies that we get funded and how much funding we're able to attract for them is a proxy. It's our best guess for how well we're doing along the way. But there are other metrics as well that people use. Some accelerators will use, some rankings will use the number of companies that are still alive and kicking after a year or 2 years. And that's a pretty reasonable metric in some ways, except when you realize that that gives accelerator programs the incentive not to call a failure a failure. They'll just, oh no, that company's still working on it. Both founders have different jobs, but no, that company is still alive and kicking. So they can play with the rankings a little bit. Or they may look at things like the percentage of companies that are funded coming out of the program after 6 months. That also may seem like a fairly reasonable metric. But then there are some accelerator programs that structure their program such that every company that graduates gets a convertible note for $100,000. Well, then they get an instant 100% on that score. So you have to understand what the rankings, how they're calculated, to see whether or not you agree with it. Now, by and large, the top 5 or top 10 are going to be the same anywhere, but it behooves you, if you're trying to pick an accelerator and you're relying on a ranking, to reach down into the rankings methodology and say, well, I don't really agree with that. Let me see if I can take that out of the equation and see what that does to the overall picture. And by the way, the MIT rankings are very good. They let you disaggregate a lot of their results and look at it on a category by category basis. So number 3, when you're trying to choose an accelerator, you have a choice between going with a generalist or a sector-focused accelerator. So over the past couple of years, one of the big trends in the accelerator program has been an industry vertical accelerator. a fintech accelerator, a food tech accelerator, a fashion tech accelerator, a security-based accelerator. And sometimes that makes sense. I would argue that in many cases, the value of being able to cross-pollinate among companies is also quite valuable. But depending on the industry, for instance, in health tech, DreamIt has its own separate health tech accelerator program, because the things that you need to know to make a successful health tech startup are that different, and the partners that you need and the type of investors that you need do only health tech. So for them, we have a separate vertical. We've done it for ed tech. We will probably do it for food tech and fintech as well. So it's not an easy decision, especially if you have a choice between a top 5 accelerator program that's generalist or a sector-based program that is new and you don't know anything about. Now ideally, if you can get a top 5 program that's also a specialist in your sector, that's a big win. Number 4, talk to alumni. These are the guys who have been in your position not that long ago, and they'll tell you the truth. They won't sugarcoat it. And in fact, I would say talk to the alumni that didn't succeed. Right? Don't forget them. There's an old saying I used to have whenever I was looking to see if I wanted an investor in my company. This is before I joined the accelerator. I would always look for the companies that failed and didn't make the VC money. So I'd have to go back and use the Internet Archive to look at their portfolio page to see what logos had disappeared from their site over the past year. And I would call those founders up, because the way the investors treat a company that did not make them money is the true measure of a person, because they don't have to be nice to them. So you can do the same thing with the accelerators. Don't just call the winners, don't just call the companies that are in your space, call the ones that are no longer out there, ones that have gone on and taken day jobs, and ask them how the program was. And lastly, and most importantly, you need to understand your needs. Do you need coaching on how to build a business, or do you just need access to funding? Or maybe the most important thing is access to new geography, right? You know that you need to open a New York office to be near your customers. And one of the best ways you can open that office and make a splash is going into an accelerator. So maybe that's the most important thing. And once you understand what the most important thing is to you, it helps focus your decisions. If it's access to a customer geography, and that accelerator isn't in your geography, you cross it off the list. That's an easy decision. If you need the hands-on coaching, and you're looking at, say, Y Combinator, which is now an entirely virtual program, where you meet once a week, then that's not for you. But if all you want is funding, Y Combinator is one of the best funding networks out there. So maybe that's the perfect decision for you. So now I'm going to pause for a minute and I'm going to get blatantly self-promotional. I'm going to tell you about DreamIt, about why I think it's a great accelerator. I'll make it short. We've helped accelerate over 200 companies at this point. We've been around since 2008. The 200 companies that we've accelerated span every industry you could possibly imagine, everything from fintech to food tech to fashion tech to ed tech to ad tech. You name it, if it's anything but a cupcake shop, we've done it. The companies that we've accelerated have raised over $270 million and have gone on and are now worth in aggregate over $800 million. And I think this number is actually a little dated. We may be up to $1 billion by now. Some of the companies that we've accelerated you may be familiar with. SeatGeek is the #1 portal for secondary purchases of tickets to sporting events or concerts. They raised a $62 million C round about 2 months ago. Level Up is the leading mobile payment and loyalty service for brick and mortar retailers. Adaptly, they're a social media ad buying platform. They raised their B round in 2012 or 2013, and they've been growing 100% year over year. The only reason they haven't raised a C round is they just don't need the money. And Meerkat. Meerkat, if you've been following anything, you know what Meerkat is. They're one of ours. Anyway, that's the end of the ad. If you want to learn more about DreamIt, please come over to me and I'm happy to tell you more about it. But for now, I want to leave you with a couple of thoughts about your company. Number one, it is your company. So regardless of the program you're in, you're going to get a lot of advice. You're going to get a lot of conflicting advice. But it's your call at the end. It's your ass on the line. So always remember that it's your decision. Number two, if you want something, you have to ask. I will tell you the same thing I tell my companies and my wife. And I rarely tell my companies and my wife the same thing. I cannot read your minds. I want to help, but you have to tell me how. Leverage networks, right? It is impossible to build a business on your own, and you are more connected now than you've ever been before. So find out who can help you. Find out who can make the introductions for you. And it makes life a lot easier. But do one thing, make this as easy as possible. So you want to go to somebody, and this is an entire separate presentation about how to do this. But when you ask for an introduction, you want to make that as easy as possible on the person you're asking. But don't forget, sometimes the people who can help you most are right next to you. They can be the guy sitting at the desk next to you at a co-working space or in an accelerator. They could be somebody in your building. It could be somebody that you go to when you play, basketball in, your neighborhood league. Don't be afraid to leverage the people around you as well. And it goes without saying, work hard, right? That's the price of admission to this game. You want to play hard as well. It is kind of a long, rough road, and if you don't have fun in a while, you will burn out. But the most important thing is, you got to go for the gold. That's why we're here. No one wants to win and not get rich, so think big. I'll pause for a moment. I'm going to take questions if you'd like, and if we can even go to a second presentation, depending on how few of you have questions. So don't be shy. Who's got the first question?
So who wants to take the first question from the? Oops. No, let's do not Larson again. Come on, guys. You have one shot, or not? Told you. Who wants to take a first question? I'm going to auction them. Yes, no. I'm going to ask myself one question though. You said, remember, it's your company. Mm-hmm. I mean, we hear that a lot, but at the same time, how do you conjure that with raising money? Because every time you raise, you're going to lose a bit of your company. So is that something you've seen in companies that you've incubated?
Sure.
Or?
So even if you take money from investors, it's still your company, at least until you no longer have voting control, then it's partly your company. But really what I mean is this is a mindset for you. And I've heard it said you should have strong opinions, but weakly held. Meaning you should have a very kind of well thought through, reasoned argument for why you're doing what you're doing, but you should be willing to listen to anybody and reconsider that. Now that said, there's some situations even if you get into a good accelerator program, you are going to get conflicting advice. You're going to get, it just happens, different people are going to have different thoughts about your company, and in some cases, they don't know what they're talking about. They made their money in real estate or selling, flowers, and you can just kind of say, well, that's probably not the most relevant advice to me. But in other cases, you're going to get 2 or 3 competent entrepreneurs, all of whom have built great businesses, and they're going to tell you different things. So it's on you to assess it. It's on you to digest it. It's on you to decide which way you want to go.
And, Titus, please.
Quick question. How do you explain the explosion of accelerators in the last 10, 15 years? Is it because people have no clue about entrepreneurship, or there's a big business in accelerators, or
I use the
or
MBA,
no reason?
No, I use the MBA model the same way. So the MBA programs, 100 years ago didn't really exist at all. And even as little as 30, 40, or 50 years ago, it was very infrequent for anyone to go through an MBA. You didn't need it. You could go ahead and you could become the CEO of a company working your entire way up without having it. Now it's come to the point in the cycle where it's extremely hard to get certain jobs without an MBA. And even jobs that you are able to get without an MBA, you could hit a glass ceiling without it. Now, the same way that market exploded as a way for people to differentiate themselves from other competition and to get a leg up skill-wise and network-wise, the accelerator market is also booming because they also, in some ways, present a signal. I was able to get into this accelerator, so I'm better than the average startup you see, where I'm learning certain skills that would be difficult for me to learn somewhere else. But then, my note of caution here is, all accelerators are not created equal the same way all MBA programs are not created equal.
So meaning at some point you'll have also 8 accelerator programs that will keep coming up in some rankings?
And we're already beginning to see that. Yeah. Just show of hands, who's actually applying to an accelerator program right now?
Somebody?
Nobody?
Nope. Who's Shit, sorry.
Who is applying to an accelerator program right now?
Who is thinking of applying at least, maybe? Oh, 3,
Okay,
4,
that's
5,
better.
6 at least.
Well, we can ask that
So maybe,
also.
no, but maybe, so maybe, yeah, so why?
So I covered it in one slide. The question was, why wouldn't you apply? And at the end of the day, most of the accelerator programs take an equity stake. So you have to decide if the increase in the percentage likelihood that your company will succeed outweighs the dilution, the piece of the company that you're giving up. In most cases, it does if you're choosing one of the better accelerator programs.
So how do you choose one of the better accelerator programs besides yours, obviously?
Well, it was the entire presentation there. It's like I said before, you start with the lists, which will give you an idea of who may be at the top of your list. You dig into how they came up with the lists to see if that tracks with what you think is meaningful, a way to measure an accelerator program. And then you see if it's a good fit for your company.
How do you choose the companies that apply to you? How do you make?
So that's a different question.
Yeah. Because
I'll
maybe
answer that, and then
some
we'll
of
take
these
the
guys
question over here.
want to
So
apply.
we choose our companies based on 4 criteria. The number 1 criteria is team. It's got to be a solid team. Nothing's going to happen unless the team is solid. And for us, we're strongly biased to having in-house tech and minimum 2 founders. It's just too much work for one person. And if you outsource, it just doesn't move fast enough. Just the nature of the business. Number 2, we like big markets. So like I said before, I hate to win and not make money, so it's got to be a big market. Number 3, you got to be at the right stage. If you need 6 months more to code, take 6 months more to code and then apply. We got 3 months with you when you're in our program, and we can do magic in 3 months if you're ready. And lastly, the idea itself has to be good, right? I mean, it can't be going up against something that's entirely owned by a large competitor who is very innovative. I don't mind it if there are a lot of people trying to tackle the problem, as long as it's not owned by somebody else. So you had a question?
Yeah, hold on, I'm coming to, so you have the microphone.
You mentioned many interesting things we should search for when applying to an accelerator. Are there any factors we should avoid?
Are there any factors you should avoid when assessing which accelerator to go into?
Choosing
So
the best one.
the number 1 thing that turns me off to the point of like me being sick in my stomach is when they ask you for money to apply. If an accelerator program or anyone offers to make introductions to investors or they pay to pitch, those are just awful. They're just awful. I mean, an angel investor has no business charging a startup founder money to pitch to them. And by and large, they are horrible programs and no one raises money there. The one exception to that in general might be if they are reputable conferences that are set up in target markets, say in New York or in Silicon Valley, and they need to pay to organize it. And even there, I feel a little bit kind of iffy about it. But I won't dismiss those out of hand.
Has anyone another question? Otherwise, you'll have because I'm going to run to you, sir.
Yeah. If there aren't questions, I'll go into another accelerator, another deck I have, and you'll just have to suffer through me. I'm not letting you out early if that's what you were hoping.
Okay, one short question about motivation of participants of the accelerator, because I think that sometimes people do not respect this whole support when they receive it for free. And if you take equity sometimes in just an idea, it's like they receive your support for free. And how do you deal with motivation of participants in accelerator? Maybe it's not a problem in a top-notch accelerators.
No, that's a very good question. So number 1, we don't take people with just ideas. If you have just an idea, you're not at the stage where you can move quickly enough in 3 months to get the full value of it. Now you have to have something. Now there's one company out there that was the closest I can think of to just an idea, was the company Adaptly that I had up there. And what they did was brilliant. They hadn't built any of the back end. All they did was build the front end. And they put it up there. And clients would come to place their social media ad buys, and they would think it was a live site. And they were actually putting real money down. And at the end of the day, the CEO was getting an email that said, this client wants to put $300,000 to target like 30-year-old men. And he would take that over to an army of like 50 interns he had, and they were manually placing these orders and manually producing reports. And then every week they would add a new feature, which was just a button, And if no one clicked the button, they took the button down. Everyone clicked the button and went way up to the top of their dev list. And they iterated once a week, every week, right? So, you know, when I say we don't take anything with just an idea, that's the closest that you can get to an idea, but they had a very clear, laid out plan. And you can't do that in every industry. You can do that where it's asynchronous. You can't do that in most, you know, B2C companies where everything has to happen in real time. Right? So in most cases, you have to have at least an alpha, if not a beta, ready to go. And it helps a lot for us if you have some customers or users. Now, in terms of whether or not just taking equity and not cash is too low a level of commitment and the people flake out, if anything, if I'm choosing good startups, they're fighting for me. They don't want to give up the equity. If they're too willing to give up the equity, that's a bad sign for me. Right.
Can you publicly reveal how much equity you take?
So it varies from accelerator to accelerator, and even within DreamIt from program to program. Our program, the entire program, soup to nuts, 3 months plus an initial investment is initially 6%, and then we'll invest up to another $250,000 in your seed round. So usually by the end of that process, it's 7 to 10% in exchange for up to $275,000.
Okay, thank you.
Cool.
Anyone else wants to pick up a question? Or you can go through quickly another deck.
Yeah, so I'll tell you what the alternative
sorry, go ahead.
is. The alternative is one that Titus has seen before. It's very nuts and bolts. How do you find investors?
You want that?
You want that, or you want questions? Or do you want to just go get a drink at the bar? I'm going to make you vote.
So who wants the next deck about how to find investors? Raise your hands. Oh, cool. Who wants to take questions? Obviously, I guess no one. Who wants to have a drink at the bar? There's no alcohol yet.
Oh, yeah, so his vote doesn't count because there's no booze. Okay, let's make it easy.
Okay, go ahead.
I'll go into the next one, and then we'll all go get drinks afterwards.
I'll give you 10, 15. Is that fine with you?
Yeah, that's fine.
Okay, great.
I didn't finish the deck anyway, so at some point I run out of slides. Yeah, I'm not joking. I didn't know I was giving this one. I need it for next week I'm in week 6 of my accelerator program. I'm playing hooky right now, and I'm giving this next presentation to them. So you're going to be my test subjects on this one. So what we're talking about here is how do you prospect for investors? By prospecting, I mean finding them, right? So what do phishing and fundraising have in common? Anyone want to take a guess? No one raises hands. What? You need bait. Close. No. But the real answer is like nothing. It's absolutely nothing. It's the absolute wrong analogy, right? If you think you can just, put out bait, even if it's good bait, and just sit there and wait for investors to nibble, you're going to be there a long, long time. If you think being patient will bring results, hey Jason, nothing's happening. And if you think you can do it solo as a one-man job, you're absolutely nuts. Hunting is the better analogy. You need to track your investor as if they're prey. You need to get as much help as possible sniffing out those tracks, and you need to be aggressive. Now, this presentation is how do you prospect for investors like a big game hunter. Meet your new best friend. This is AngelList. Show of hands, who here knows what AngelList is? Good, okay, perfect. So here's how you use AngelList to build a prospect list. You start with a comparable company. Now, you may say, oh, no one does what I do, and that's bullshit, right? Somebody does something that's vaguely like what you do. Or at the very least, they're in the same space, but maybe a different market. So you may be the Uber for dog walking. Well, okay, I hate that analogy too. But there are things to do with pets, that's a comparable. There are things to do with on-demand economy, service economy. Those two sectors are comparables for you. So the sentence you should have in your mind when thinking about whether or not that other company is relevant for you is, so Jason, I see you're invested in companies A, B, and C. I think you might be interested in mine because I do whatever I do. So if the A, B, and C actually sound relevant given what you do, then they are relevant. Those are comparable companies. So you're going to find those companies, starting with at least one, and you're going to make a note of all the investors in that company. Then you're going to go over to the investors page in AngelList, and you're going to see what other companies they're in. And you're going to make a list of those. And then you're going to iterate back and forth, back and forth. This is what the angel list page looks like for a particular company. Right? Doesn't matter what company it is, just go to the company. You can read the description way at top. Actually, you can't, it's too far away, but it doesn't matter. On the actual page, you can usually tell in one sentence whether or not that company has anything to do with yours. You're going to go to the page that says fundraising, right there. All the people that invested in their round. It's not perfect. Not everybody lists themselves up there, but it's a heck of a lot better than we had 5 years ago. You make a note of all those people that invested. Then you jump over to that specific investor, and you scroll down. It'll have all the investments that he's done on AngelList. Just make a note of them all, especially if they're in your space. Now, one note of caution. There are some companies that are your direct competitors. You probably don't want to reach out to those investors. There are fewer direct competitors than you think, but there are some. So if you were Lyft, you probably didn't want to approach Uber's investors. This is something that I do to keep track of the investors that I've pulled together through this process. You can do this probably better as a database, but it's easier to use spreadsheets, so whatever works for you. Name of the investor, the total number of relevant investments that you found, and just a link, just all with the names of all those other investments, right? So if you do this, and you repeat this over and over, you should in fairly short order get to about 50 or 100 prospects. And that is the number you want to target. If you think that you're going to start off with 10 prospects and magically raise money on that, it ain't going to happen. 50 to 100 is kind of the bogey you want to shoot for. And I'll give you another hint. When you start pitching, aim for your B list, right? They're interested enough that it's relevant what you're going to say, but if you screw it up, it ain't the end of the world. Once you're really confident in your pitch, you've nailed out, you've anticipated all the questions people ask, then you move up to your A list and you hit those hard. And just if it wasn't clear what I meant by A and B and C, the A list investors are the most active. The B list are moderately active, they're still pretty good prospects, and the C lists, I mean, they've made 1 or 2 investments in your space, so they may not be interested in you at all. It might just be, I don't know, their cousin went into the space and they had to invest in it. That's what I mean by A list, B list, and C list. This is a fail. What it's supposed to say is your new best friend is LinkedIn. On LinkedIn, you can figure out how you're connected to those specific investors. So if you type in Alessandro Piol as one of the investors in the company that's similar to yours, you'll come up with this page. It's about 2/3 of the way down the page, depending on how they set up their profile. It's all the people that you and he have in common. Now this only works if you're a 2nd-degree connection to him. So if you're a 3rd-degree connection, just skip that person, you'll come back to him later. Now you're going to make a list. You're going to do the same thing that you did for startups and the investors in them. You're going to do for the investors and the connections that you have to them. So what I just said. Now, this is where I ran out of slides, so I'm going to start talking and waving my hands a little bit. For each of those investors, you're going to come up with a number of potential introductions or introducers. You do not want to hit the same person over and over again. No matter how much he loves you, with rare exceptions, he's going to get tired of making introductions for you. So when you come up with that full list of potential introducers, split up your introducers into 3 buckets. Number 1 is the unlimited introduction buckets. Your mom will make as many introductions as you want her to. Friends and family in general. The people who run the accelerator program that you're in, you can ask them for all the introductions in the world. That's what they're there for, right? You want to use them first. On the other end of the spectrum, they're the people that you cannot ask for introductions. They may not know you well enough to actually, with a straight face, recommend you. Or they may not like you. So put them off the list right away. And in the middle, they're the people that you can use within reason, right? And they're probably good for 2 or 3, even 4 recommendations a month, if you're polite about it and you're grateful about it. For those, you want to spread the wealth. So all the investors that you haven't gotten to using the unlimited introductions, you're going to try to figure out how you can spread those around the investors that you have left. Then you're going to make the introductions as easy as possible. I'm going to go back because it just looks weird if I leave that one slide up. So you want to make the introductions as easy as possible, and I alluded to this in my last presentation. So what does it mean? Your goal with an introduction is to get to one of 2 points as quickly as possible. You want a quick yes, ideally, or failing that, you want a quick no. And the reason a quick no is as important, or almost as important, is because if that person is not going to make the intro for you, you want to go to the next person on your list and ask them. The last thing you want is to have asked for an intro and not know if it were made. Because you don't want to ask 5 people for the same intro if you don't have to. Because then you're just burning, you're burning your credit with them. So how do you get a fast answer one way or the other? You start off with an easy as possible email. And it starts with the subject line, because that's the first thing they're going to see. Do not say intro request. That means nothing when it hits somebody's subject box, their inbox. You want it to say, my company wants to meet target, right? As simple as possible. Why do we with your company, we lead with your company name, because when it's forwarded to somebody else, that's going to be the first thing that shows up in their box, even if the tail end of the subject gets cut off. Remember, the target knows who he is or she is. There's absolutely no need to start with their name. So, my company wants to meet target. That's the subject line. The body of your email has 3 or 4 sentences maximum. The reason we say 3 or 4 sentences maximum is because if you write more, they're not going to read it. They just won't. So make it very simple. And it might be something like this. I might say, let's say Paul was going to introduce me to, I don't know, Ron Conway. So I'd say, Paul, it was great chatting the other day. Thank you for your offer to introduce me to Ron Conway. As we discussed, my company is Uber for dog walkers. Ron has invested in Uber for haircuts and Uber for drones, so I thought he might be interested in my company. Do you know Ron well enough to make an introduction? So let's break that up. First sentence, I'm just being nice, I'm saying thank you, right? And I'm making it clear who I want him to introduce me to. Number 2, I'm restating what my company does. Now, Paul probably remembers, but let's make it easy on Paul. Let's not make him have to actually type anything. He can just hit forward now. Plus, if I rely on somebody else to present my company, they could screw it up. Not on purpose, but that's just the way they phrase it. It might just not be the way I know to phrase it, because I've tested it on dozens of people and I know which phrases are least likely to lead them into the wrong direction. Number 3, I said why Ron wants to talk to me. I listed in this case the investments that he's made in my space. So then when Ron gets the email forwarded to him, he can look at that and says, that's right, I did invest in Uber for haircuts. I did invest in Uber for drones. I haven't seen Uber for dog walking yet. That might be interesting, right? And then at the end, and this is a subtle point but important, I ended with, do you know Ron well enough to make an introduction? Now, the reason I did that, or some variation, are you comfortable making an intro? The reason I did that is, let's say Paul just really doesn't like me that much, but I don't know it. Or let's say he likes me, but he thinks my idea is the stupidest thing he's seen in months. And he's not going to introduce me to Ron, because that would just ruin his credit with Ron to put such a dumb idea in front of him. So I want to give him an easy out. Because if I don't give him an easy out, he's just probably going to ignore the email and hope I forget. Right? And then I lose a week before I remember to send Paul another email saying, hey Paul, did you ever forward that email to Ron? And then he'll say, oh no, I totally forgot. And then he'll sit on it again for another week, right? So I've lost 2 weeks. So instead, I make it very easy for him. He can just say, yeah, I met Ron at a conference 3 years ago. If you can get a warmer intro, that's probably better. And that's great. That may be true, may not be true. I don't care. It tells me what I need to know, which is I need to ask somebody else for that intro. Quick no. So that's it. Those are the elements of how to ask the intro. There are a couple of, fielder's choice. Do you include a link to your deck, or do you include your full deck, or do you include a one-pager? Different people have different opinions. Some people will put a longer description kind of below the signature in case people want more detail. Some people will attach a one-pager. I personally would never attach more than 1 page. I think it's a little aggressive. It's like, when you went on that date with someone and he or she started off on the first date and told you exactly how many kids he or she wanted, right? And where they wanted to live and what their mother thinks about the people that they dated before. It's just too much, right? But that's me. Different people have different levels of comfort. Some people won't attach anything. remember though, the number one thing you're looking for here is to get to the next level. You just want to get that intro done, and you want to get in front of that that investor. So, bonus points. Last couple of slides here. The elevator pitch, right? Eventually you will be in front of the person you want to meet. Now, maybe because Paul introduced me to Ron, or it may be because I'm at a conference and I happen to bump into him. So there is a skill to the elevator pitch, and it goes back to what I was saying a moment before. You have a limited amount of time, so you want to be concise, right? You have a limited amount of attention. You know, Ron's just got out of a meeting. He knows he's got 50 emails he's got to bang through. He's already mentally somewhere else. And number 3, he's probably been pitched 15 times today, if not 55 times today. So you need to be concise and attention-getting. The goal here with an elevator pitch is not to sell your company to them. The goal is not to answer all their possible questions. Your goal is to get them to ask more information. If they lean forward and ask you a question, and that question is not, I have no idea what you're talking about, you know, can you say that again? If their question is meaningful, it's like, oh, that's very interesting. How does your business model work? Or, oh, that's cool. How do you charge? Or, that's cool. It's kind of similar to this company. How are you different? Then that's okay. You've got them to engage. Your goal is only to get them to that next level of interest. If that happens, your elevator pitch is a success. So I'm a big guy. I'm big on analogies, right? I used the MBA analogy before. I'm going to use a dating analogy now. So let's say you wanted to set, let's say, a friend up with a girl. How would this work? Oh, she's born in Atlanta and she moved to New York for college, but she initially majored in English before she switched to law. She loved law school, but then she hated being a lawyer, and don't all lawyers hate being lawyers anyway. She wants 3 kids, a house in the burbs, not too far from the city, so she has the option of coming into the city for plays. And she likes mostly musicals, not dramas, but that's not because she's shallow, it's just her thing. And I'm bored already, right? This is the world's worst intro you could possibly come up with, right? There's no focus, it's way too much information. Think about this intro instead. She's cute, she's funny, and she likes hockey, right? There, this one, he wants the intro right now. That's all you need to say, because then he's like, really, what team? He's hooked, right? Or, hey, show me your Facebook page, because he wants to see a picture. He wants to know if like what I think is cute is really what he thinks is cute. That's all you need to get the interest level up. So that's what I mean. I apologize if that's a little sexist, but that's what the elevator pitch is all about. It's just getting that guy to lean forward and engage. So let's talk this in a little bit more detail. So what makes for a good elevator pitch? A good elevator pitch is clear. If your grandma gets it, you've accomplished that mission. It's concise. Don't say with 5 words what you can say with 2 words. It has both a problem and a solution, right? Seems simple, but I see a lot of pitches that don't have that. And it has to have a huge market, otherwise why do I care? On the flip side, what's a bad pitch? A bad elevator pitch? Technical jargon. Stuff that it bothers you even to say and no one gets. Too sales pitchy, right? This is a conversation. If it sounds like you're reading it or if it sounds like you're standing behind a lectern, wrong tone. Overused or stretched analogies, we're Ubers for grasshoppers, right? I mean, every time I hear people say it as a Tinder-like interface, I throw up in my mouth a little bit, okay? It may be concise, but please don't overuse these analogies. And then this is one of my personal pet peeves. When you tell someone it has to be a 15 to 30 second pitch and they take a 1-minute pitch and they squeeze it all down into one long run-on sentence without breathing just so they can get under the 30-second mark. That doesn't work. I like to recommend that people use what's called the Mad Libs approach. Now this is kind of an American thing, so just so I know, does anyone here know what Mad Libs are? Okay, Jason, I know where you come from, New York, it's cool. So Jason and I, being the only New Yorkers in the room, know Mad Libs. It's a game kids play. It's a sheet with the story on it with keywords missing. So I might have on my sheet of paper, here's my Mad Lib, and I would say, Jason, I need a noun. And Jason would say, I need a noun. He would say startup, okay, and then I'd say I need an adjective, and he would say blue, whatever it might be. And then I would read the story, And it would make absolutely no sense because none of the nouns had anything to do with the story and the adjectives had no sense to the story, and it's just funny. But in this context, what it means is you fill in the blanks. So the way you can fill in a blank with an elevator pitch is quite simple. Your company, and don't forget your company name. It happens a lot. Your company is, makes, or provides, and then you go on to what you do, for the market size / industry, the X billion dollar group fitness industry. For whom, right? Who's your customer, right? And what their pain point is. And then by how you actually solve the problem. It's that simple. You fill in the blanks. So here's one. It technically meets the requirements, but let me read it to you, right? NewCo is a mobile social networking app that helps meet customer needs and facilitates outstanding, I can't even read it down there, service using web mashups to help any company in the industry pivot to leverage a social graph and deliver triple bottom line. Okay, I have no idea what that does, right? All jargon, no clear customer, no clear pain point, right? That's a bad pitch. A little better here. NewCo enables members to capitalize on their existing social network to safely monetize underutilized assets, find and access available assets, and strengthen their social ties in real-world exchanges. I still don't know what they do, but at least I know it has something to do with buying, selling, or renting stuff that's otherwise unused. So we're getting there. Now, let's try this one on for size. My company, NewCo, is developing an online marketplace that helps hip professionals gain access to desirable vacation properties while earning money from their own properties by taking advantage of their social network. Show of hands, who knows what company that is? Go ahead. Airbnb, great. That's a good pitch because we know exactly what it is. Right? The one thing they're missing is market size. They didn't say how many billions of dollars that is. But they said who their customer is, hip professionals, what the problem is, right? Not being able to find great vacation properties. It's implied, but the problem's there. And also what their solution is, how they can do it through their social networks. Now I'm going to give you just 2 examples from the companies in the DreamIt cohort right now, and I'll give you a sense of how this works in the real world. There we go. Servi is a network of vetted mystery diners. Mystery shopping is a billion-dollar industry, but restaurants simply cannot afford to pay up to $500 per review. With Servi, restaurants can get 10 times the data for a fraction of the cost, and in some cases, they even profit on a mystery diner. We're currently working with over 50 restaurants, including, and I'm not going to name names. So let's look at this through the Mad Libs approach, right? Company name right up front. Great, they didn't forget that. What are they? Vetted mystery diners. How big is the industry? $1 billion. And it's restaurants. What's the problem? It costs a lot of money to get this feedback. How do they solve it? Well, they do it at a fraction of the cost, and they can sometimes even make money on it. And traction, it's always good to throw traction in. Now, the next question is like, well, how do you do it at 1/10 of the cost? But that's a win, right? The investor just leaned forward and asked a question. He's engaged. Last example, and then I'll turn it over. At $4 billion, group fitness is the fastest growing segment of the fitness industry, but it's incredibly inefficient. There is no method, by the way, I look up because the edge of this screen is cut off, I can't read it. There's no method to manage excess inventory without cannibalizing current customers. We at Dibs have built a proprietary algorithm that enables studios to price classes dynamically according to real-time demand, following the same path as many industries such as airlines, hotels, sporting events, and Uber, ensuring that no money is left on the table. Now, that one ran a little bit long, but I don't think it was a problem, right? I think people were engaged here. So number 1, market size. Number 2, who? The group fitness industry. Number 3, the problem, right? They're leaving money on the table. To fill seats, they discount down to the bottom. The solution, peak load pricing, right? It's all there. Slightly different order, right? You can play with the order, whatever makes sense for your industry, but it's all there. So if we have any times, what I'd be happy to do is if you guys want to stand up and give me your elevator pitch, I'll be happy to tear it apart for you.
Actually, I'm sorry, we don't have time here, but you're gonna...
Okay, come to me later.
Yeah, you're gonna stay, right?
Yeah, I'm going to stick around.
Okay, so what we could do, if anyone wants to actually do it right now, you can actually just meet him just at the back of the room and try your luck and see if he destroys you or not. Be wary, he's a New Yorker, he will destroy you.
And Paul was worried I'd run out of
That's fine. If you want to conclude with something, go ahead.
No, that's it. You know, as I said before, it's a pleasure to be here. I am very jet lagged, so somewhere back there we may try to find me a coffee. But other than that, I'm happy to stay and I'm happy to talk to all you guys either about your companies, about the startups you have in mind, or about DreamIt if you're at that stage. Thank you. I appreciate it.
Thank you so much. That was great.